Venture Deals by Brad Feld and Jason Mendelson. Raising venture capital is a high-stakes game where the rules often seem hidden and the stakes are enormous. In Venture Deals, Brad Feld and Jason Mendelson pull back the curtain on the world of venture capital, offering entrepreneurs and investors an insider's guide to understanding the terms, dynamics, and strategies that define successful fundraising. This book is a comprehensive manual for navigating term sheets, negotiating with venture capitalists, and managing the complex relationships that drive startup growth. Feld and Mendelson use their decades of experience to break down the nuances of venture deals, empowering you to approach negotiations with confidence and clarity. Whether you are an entrepreneur raising your first round of capital or a seasoned investor looking to refine your approach, this book equips you with the tools to secure the best possible deal while maintaining long-term alignment with your partners. Lesson 1. Understand the term sheet. The term sheet is the cornerstone of any venture deal, and your ability to navigate its complexities can determine the success of your business. Brad Feld and Jason Mendelson stress that understanding every element of the term sheet, valuation, liquidation preferences, board composition, and more, is essential to maintaining a fair balance of power between founders and investors. Far from being a mere formality, the term sheet is a detailed framework that shapes the relationship and expectations between the parties involved. Misunderstand its implications, and you risk jeopardizing your company's long-term success. Valuation is often the most discussed element of a term sheet, but Feld and Mendelson caution against letting it overshadow other critical components. While a high valuation may seem like a victory, the terms surrounding it can significantly impact your control and financial outcome. For example, liquidation preferences dictate who gets paid first in the event of a sale or liquidation. A seemingly favorable valuation can become less advantageous if the liquidation preferences heavily favor investors. Feld recounts instances where founders celebrated high valuations only to discover later that they received little to no payout due to stringent liquidation clauses. Board composition is another pivotal term. The composition of your board directly affects decision-making and governance. A balanced board, with representation from both founders and investors, ensures that no single party dominates. Feld emphasizes the importance of negotiating a structure that preserves your vision while addressing investors' interests. Without careful attention to this detail, you may find yourself sidelined in key decisions about the company's direction. This focus on preparation and negotiation mirrors lessons from Michael Wheeler's The Art of Negotiation, where understanding every detail and anticipating the other party's needs are critical to achieving favorable outcomes. Wheeler stresses that successful negotiators prepare thoroughly, knowing that even small details can have far-reaching implications. The same principle applies to term sheets. A single overlooked clause can shift the balance of power or create unforeseen liabilities. Enter negotiations armed with a deep understanding of the document and the confidence to advocate for your interests. Feld and Mendelson recount how inexperienced entrepreneurs often fail to grasp the nuances of a term sheet, prioritizing speed or perceived goodwill over due diligence. This mistake can lead to regret when terms come into effect during critical moments, such as future funding rounds, acquisitions, or exits. For instance, anti-dilution clauses, which protect investors from losing value in the event of down rounds, may seem benign initially but can significantly dilute a founder's equity if not carefully negotiated. To avoid these pitfalls, you must learn the language of term sheets. Familiarize yourself with terms like participating preferred stock, vesting schedules, and drag-along rights. Each has specific implications for ownership, control, and financial outcomes. Education is your first line of defense. Understanding these terms equips you to engage meaningfully in negotiations and ensures that you're not blindsided by provisions buried in the fine print. Seeking expert advice is equally critical. Venture deals are intricate, and even seasoned entrepreneurs rely on legal counsel and advisors to navigate them. A skilled attorney with experience in venture capital can help you identify red flags and negotiate terms that align with your goals. Feld emphasizes that paying for expert guidance up front is an investment in protecting your company's future. It is far more costly to rectify unfavorable terms after the fact than to negotiate them correctly from the start. Approaching term sheet negotiations with knowledge and preparation also enhances your credibility with investors. Investors respect founders who understand the details and can articulate their needs confidently. This dynamic fosters trust and sets the tone for a collaborative partnership. Negotiating effectively doesn't mean being combative. It means advocating for a fair balance that ensures mutual success. Ethics and transparency are also essential when discussing the term sheet. Be clear about your priorities and listen to your investors' concerns. Feld and Mendelson advocate for open communication, which lays the foundation for a relationship built on trust. Negotiations are not a zero-sum game. Both parties should feel that their interests are protected and that they are aligned on the company's mission and strategy. Ultimately, understanding the term sheet is about empowerment. It allows you to make informed decisions, protect your interests, and build a strong foundation for your company's future. Every clause, from valuation to board composition, has a purpose and a consequence. Approach the term sheet with the seriousness it deserves. Study its elements, seek expert guidance, and engage in negotiations with confidence and clarity. A well-negotiated term sheet sets the stage for a successful partnership, enabling you to focus on building your business without fear of hidden surprises. Lesson 2. Optimize valuation carefully. Valuation is often the most visible and celebrated aspect of venture capital deals, but Brad Feld and Jason Mendelson caution that it is only one piece of a much larger puzzle. While securing a high valuation can feel like a win, focusing on it at the expense of other terms can lead to long-term challenges that outweigh any short-term gains. The founders who achieve sustainable success are those who approach valuation strategically, balancing it carefully with the other components of their term sheets. Feld and Mendelson share stories of startups that landed impressive valuations but were later crippled by unfavorable terms. Aggressive liquidation preferences, investor veto rights, and burdensome anti-dilution clauses can severely limit a founder's ability to steer the company or reap the rewards of success. For example, a high valuation with a 2x or 3x liquidation preference can mean that even in a lucrative exit, founders walk away with little to show for their hard work. These cautionary tales highlight that valuation must always be considered in the broader context of the deal. This principle aligns with Ben Horowitz's insights in The Hard Thing About Hard Things, where he warns against celebrating short-term wins that create long-term problems. A high valuation may attract headlines and give the appearance of rapid progress, but it can set unrealistic expectations for future growth or create pressure to overperform in subsequent funding rounds. If the business cannot sustain the valuation, it risks triggering down rounds or diluting founder equity significantly. Horowitz reminds entrepreneurs that building a successful company is a marathon, not a sprint, and decisions should reflect a long-term perspective. To optimize valuation, you must first understand its relationship to other terms in the term sheet. Feld and Mendelson emphasize the importance of founder-friendly terms that provide flexibility and preserve ownership. A slightly lower valuation with favorable terms, such as capped liquidation preferences, fair anti-dilution provisions, and a balanced board structure, often results in better outcomes for founders. These terms give you the breathing room to focus on building your business rather than navigating complex investor dynamics. Another key consideration is the impact of valuation on your ability to raise future funding. A high valuation can be a double-edged sword. While it may position your company as a market leader, it also raises the bar for subsequent funding rounds. If you fail to meet the expectations implied by the valuation, you risk a down round, which can damage credibility and morale. Feld recounts instances where companies that secured aggressive valuations struggled to justify them in later rounds, leading to difficult renegotiations and strained relationships with investors. Valuation also affects your company's cap table and overall equity dynamics. A lower valuation may require you to give up more equity initially, but it can prevent excessive dilution in future rounds. Founders who prioritize long-term equity retention often find that modest initial valuations provide greater control and financial rewards over the life of the company. Understanding how different valuation scenarios impact your cap table is essential to making informed decisions. Negotiating valuation requires clear communication and a focus on alignment with your investors. Feld and Mendelson stress that successful partnerships are built on shared goals and mutual respect. Investors who push for an inflated valuation may not have the company's best interests at heart. Conversely, investors who advocate for balanced terms demonstrate a commitment to the company's long-term success. Seek out investors who understand your vision and are willing to collaborate on structuring a deal that supports sustainable growth. Ethical considerations also play a role in optimizing valuation. Entrepreneurs have a responsibility to ensure that valuations accurately reflect the business's performance and potential. Inflating numbers to secure a higher valuation may yield short-term benefits, but can erode trust with investors, employees, and stakeholders. Transparency and honesty in financial reporting and growth projections are critical to building credibility and fostering a culture of integrity. Feld and Mendelson encourage founders to seek advice from experienced advisors and legal counsel when negotiating valuation. These experts can help you understand the implications of various terms and ensure that your decisions align with your long-term goals. They also provide an objective perspective, helping you balance your aspirations with the realities of the market. Ultimately, optimizing valuation is about prioritizing sustainable success over immediate gratification. A balanced approach ensures that you retain the flexibility, control, and resources needed to build a thriving business. Consider the broader context of your term sheet, anticipate the downstream effects of your decisions, and negotiate with a focus on creating a strong foundation for growth. A fair valuation with founder-friendly terms is not just a good deal, it's the right deal. Lesson 3. Master liquidation preferences. Liquidation preferences are one of the most critical and complex elements of a term sheet, and misunderstanding them can lead to disappointing outcomes, especially during an exit. Brad Feld and Jason Mendelson emphasize that liquidation preferences dictate how proceeds are distributed in an acquisition, merger, or liquidation, directly affecting what founders, employees, and investors ultimately receive. Ignoring or underestimating these terms can result in painful surprises, even when a sale appears lucrative on paper. At their core, liquidation preferences determine the order and amount of payouts. For example, a standard 1x liquidation preference ensures that investors recoup their initial investment before any remaining proceeds are shared. However, more complex terms, such as participating preferred stock, can dramatically shift the balance. Participating preferred stock gives investors both their preference payout and a share of the remaining proceeds, which can significantly reduce what founders and employees receive. Feld and Mendelson recount real-world cases where founders celebrated high valuations only to find that these preferences left them with a fraction of the exit proceeds. This lesson aligns with Warren Buffett's sage advice. Always know the downside before you focus on the upside. While optimistic projections and growth potential are essential, you must fully understand the financial implications of liquidation preferences under worst-case scenarios. Without this knowledge, you risk entering agreements that favor investors disproportionately, eroding the value of your equity. To master liquidation preferences, start by learning the terminology and mechanics. Common terms include non-participating preferred, participating preferred, and capped participation. Non-participating preferred stock offers a straightforward arrangement. Investors choose either their liquidation preference or their pro rata share of the proceeds, whichever is higher. Participating preferred, on the other hand, allows investors to double dip, taking their preference payout first and then sharing in the remaining proceeds. Capped participation limits the extent of this double dipping, offering a compromise between founder and investor interests. Feld and Mendelson emphasize that the devil is in the details. For example, A 2x or 3x liquidation preference means that investors receive 2 or 3 times their original investment before others see any proceeds. In a modest exit, such terms can leave founders and employees with little to no payout, even if the sale price appears substantial. Calculating the impact of these terms under different scenarios is essential to understanding their real-world implications. This focus on downside protection mirrors the principles of risk management found in financial investing. Just as investors evaluate the risk of loss before pursuing potential gains, founders must anticipate how liquidation preferences could play out in various exit scenarios. Feld and Mendelson advise founders to run the numbers, considering outcomes ranging from worst case to best case. Tools like cap table management software can help visualize these distributions and inform negotiation strategies. Negotiating favorable terms around liquidation preferences is key to preserving equity value. While some preferences, like a standard 1x non-participating preferred, are considered industry norms, others may be open to adjustment. For instance, you could negotiate for capped participation or convert participating preferred stock into non-participating if the payout exceeds a certain threshold. These compromises balance investor protection with founder interests, ensuring fair outcomes for all parties. The broader context of your term sheet also matters. Liquidation preferences interact with other terms, such as valuation, anti-dilution provisions, and board composition. A seemingly favorable valuation can become less attractive if paired with aggressive preferences, while balanced terms create a foundation for sustainable growth and partnership. Feld and Mendelson stress the importance of viewing the term sheet as an integrated whole, rather than evaluating each term in isolation. Seeking expert advice is indispensable when navigating liquidation preferences. Experienced attorneys and advisors can help you decipher the fine print, identify red flags, and negotiate terms that align with your goals. Feld notes that founders who invest in legal counsel up front often save themselves from costly mistakes down the line. These experts can also provide insights into industry standards, helping you assess whether investor demands are reasonable. Ethical considerations also play a role. Transparent communication with your team about the implications of liquidation preferences fosters trust and aligns everyone's expectations. Employees who receive equity as part of their compensation deserve to understand how these terms affect their potential payouts. By addressing these issues openly, you build a culture of fairness and accountability. Ultimately, mastering liquidation preferences is about safeguarding your equity and ensuring that your hard work pays off. Understand the terms, run the numbers, and approach negotiations with a clear strategy. Remember that the best deals balance risk and reward, protecting investors while preserving value for founders and employees. By mastering this critical aspect of venture deals, you set yourself up for success, both during the journey and at the finish line. Lesson 4. Build collaborative relationships. Venture deals go far beyond the exchange of capital. They hinge on the quality of the relationships you build. Brad Feld and Jason Mendelson stress that the partnership between founders and investors is as critical as the financial terms of the deal. Misaligned values, clashing personalities, or poor communication can derail even the most promising ventures. On the other hand, strong, collaborative relationships with your investors can become a powerful catalyst for growth, providing not only funding but also guidance, connections, and strategic insight. Feld and Mendelson recount stories of both successful and failed founder-investor dynamics. In one instance, a toxic relationship between a founder and an investor created mistrust, paralyzed decision-making, and ultimately led to the company's downfall. In contrast, companies that thrived often had founders and investors who treated each other as partners, aligned on the company's vision, and worked together through challenges. These stories illustrate that the right investor can offer far more than money. They bring expertise, industry knowledge, and a network that can open doors to opportunities you might not access otherwise. This principle mirrors Reid Hoffman's insights in The Startup of You, where relationships and networks are presented as the foundation of success. Hoffman argues that professional growth and opportunity are driven by strong, authentic connections. The same holds true for venture capital. Choosing the right investors means finding individuals who not only believe in your vision, but also share your commitment to building something meaningful. Your investors should be allies who actively contribute to your journey, not just silent financiers expecting returns. To build collaborative relationships, start by selecting investors who align with your values and goals. During the due diligence process, evaluate potential investors as thoroughly as they evaluate you. Ask yourself, do they understand your industry? Do they have a track record of supporting companies through similar stages of growth? Do their communication style and decision-making approach align with yours? Feld and Mendelson advise founders to prioritize fit over the size of the check. An investor who shares your vision and offers strategic insight will provide far greater value than one who simply provides capital without engagement. Trust is the cornerstone of any successful founder-investor relationship. Feld and Mendelson emphasize the importance of transparency and honesty from the outset. Share your vision, your challenges, and your aspirations openly, and encourage your investors to do the same. Trust is built through consistent communication and mutual respect. Founders who proactively share updates, both good and bad, foster a sense of partnership, ensuring that investors feel informed and included. This openness not only strengthens relationships but also helps you navigate tough times with the support of your backers. Strong relationships also require clear expectations. Define roles, responsibilities, and boundaries early on. Investors who take an active role in your company should have clearly delineated areas where they can add value without overstepping into daily operations. Conversely, founders must respect investors' perspectives and insights, recognizing that their involvement is often rooted in experience and a genuine desire to help. Feld and Mendelson stress that miscommunication or unmet expectations can quickly erode trust, so clarity is essential. Building collaborative relationships also involves acknowledging the emotional side of the journey. Entrepreneurship is filled with highs and lows, and having investors who empathize with your challenges can make all the difference. Feld and Mendelson recount instances where supportive investors stepped in during crises, offering not only financial resources, but also encouragement and advice. These moments underscore the importance of choosing investors who are not only skilled, but also compassionate and committed to your long-term success. Beyond the personal relationship, strong investors bring resources that extend your company's capabilities. Their networks can help you recruit top talent, forge strategic partnerships, and secure additional funding. They can offer guidance on navigating industry dynamics, scaling operations, or preparing for an exit. Feld and Mendelson encourage founders to actively leverage these resources, treating their investors as strategic partners rather than transactional stakeholders. Ethical considerations are also central to collaborative relationships. Just as you seek trustworthy investors, you must uphold your commitments and act with integrity. Founders who misrepresent their business or fail to honor agreements damage relationships and erode trust. A foundation of ethical behavior ensures that both parties can focus on shared goals without distractions or mistrust. Ultimately, building collaborative relationships with investors is about creating a partnership that amplifies your strengths and supports your vision. Venture deals are not one-sided. They are mutual commitments to a shared journey. Choose investors who align with your values, communicate openly, and bring more than money to the table. By treating your investors as true partners, you unlock not only their capital but also their expertise, networks, and dedication to your success. Lesson 5. Negotiate with confidence. Negotiation is not just a transactional skill. It's a strategic tool that can define the future of your business. Brad Feld and Jason Mendelson emphasize that successful founders approach negotiations with a combination of confidence, preparation, and clarity. The ability to navigate tough discussions, find mutually beneficial outcomes, and stand firm on what matters most is crucial in the high-stakes world of venture deals. A well-negotiated deal isn't about winning, it's about creating a foundation for long-term success. Feld and Mendelson recount stories of founders who mastered negotiation by knowing their priorities and refusing to compromise on critical terms. One example involved a founder who faced pressure to accept aggressive liquidation preferences in exchange for a higher valuation. Rather than yielding, the founder stood firm on securing more balanced terms, even at the cost of a lower valuation. This decision ultimately protected their equity and allowed them to maintain control of the company, demonstrating that knowing when to hold your ground can lead to better long-term outcomes. This lesson echoes Chris Voss's principles in Never Split the Difference, where he describes negotiation as a blend of tactical empathy and disciplined strategy. Voss emphasizes that preparation and understanding the motivations of the other party are the keys to successful negotiations. Feld and Mendelson share a similar view, stressing the importance of entering negotiations with a clear understanding of your priorities, the other party's goals, and the potential trade-offs involved. This clarity allows you to approach the conversation with confidence and focus, ensuring that you protect what matters most while fostering collaboration. Preparation is the cornerstone of confident negotiation. Feld and Mendelson advise founders to do their homework before stepping into discussions. This includes understanding the market norms for valuation, liquidation preferences, and other key terms, as well as analyzing how these terms interact within your specific deal. For example, a higher valuation may seem appealing, but if paired with unfavorable preferences or anti-dilution clauses, it can erode your equity over time. By understanding the nuances of the term sheet and anticipating potential outcomes, you position yourself to negotiate effectively. Clarity about your priorities is equally critical. Not every term in a negotiation carries the same weight, and successful founders know which battles are worth fighting. Feld and Mendelson encourage founders to rank their priorities and approach the discussion with a clear sense of what they are willing to compromise on and what they are not. For instance, retaining board control or securing a balanced equity split may be non-negotiable, while other terms, such as vesting schedules, may offer more flexibility. This focused approach ensures that you allocate your energy to the terms that matter most. Negotiation is not about aggression or domination. It's about collaboration and mutual benefit. Feld and Mendelson stress that the best deals align the interests of both founders and investors, creating a win-win scenario. Founders who approach negotiations with an adversarial mindset risk damaging relationships and missing out on opportunities for partnership. Instead, adopt a tone of openness and respect, seeking to understand the other party's perspective while clearly articulating your own. This approach fosters trust and paves the way for constructive dialogue. Timing also plays a role in effective negotiation. Feld and Mendelson caution against rushing into deals without fully understanding the implications. They recount examples of founders who signed term sheets hastily, only to regret unfavorable terms later. Take the time to review offers thoroughly, seek advice from legal and financial advisors, and ensure that you're negotiating from a position of strength rather than urgency. Tactical empathy, as described by Voss, is another powerful tool. Understanding the motivations, fears, and priorities of the other party allows you to craft proposals that address their concerns while protecting your interests. For instance, investors may prioritize downside protection or assurances of future growth. By addressing these concerns with thoughtful compromises, such as capped liquidation preferences or performance milestones, you demonstrate a willingness to collaborate without sacrificing your key goals. Confidence is built through preparation, clarity, and practice. Feld and Mendelson emphasize that first-time founders often feel intimidated by seasoned investors. But it's important to remember that you bring unique value to the table, your vision, passion, and expertise. Approach negotiations with the mindset that you are an equal partner in the deal, not a subordinate. This perspective shifts the dynamic and empowers you to advocate effectively for your company's needs. Finally, negotiation is a continuous process, not a one-time event. As your relationship with investors evolves, so will the terms of your partnership. Feld and Mendelson encourage founders to maintain open communication and revisit agreements as circumstances change. A deal that benefits both sides today should continue to do so as the company grows, ensuring that the partnership remains strong and aligned. Ultimately, negotiating with confidence is about protecting your company's future while fostering collaboration and trust. Enter discussions with preparation, clarity, and empathy. Know your priorities, communicate openly, and approach each term as an opportunity to create alignment. A well-negotiated deal doesn't just secure funding, it lays the foundation for a successful partnership that supports your vision and drives long-term success. Lesson 6. Protect founder equity. Equity is more than just a financial asset. It represents your control, your vision, and your stake in the company's future. Brad Feld and Jason Mendelson emphasize that protecting founder equity is essential, even as dilution becomes an inevitable part of raising venture capital. Founders who fail to safeguard their equity often find themselves losing control, influence, and motivation. Negotiating the right protections ensures that your ownership remains aligned with your contributions and your vision. Feld and Mendelson recount cautionary tales of founders who lost significant equity due to poorly structured deals. In one instance, a founder accepted multiple rounds of funding without fully understanding the impact of dilution and anti-dilution provisions. By the time the company was acquired, the founder's equity had been diluted to such an extent that their financial outcome was negligible compared to the value they had created. These stories underscore the importance of proactive planning and informed negotiation to avoid such outcomes. This lesson echoes the insights in David Gladstone's Venture Capital Handbook, where founder control is positioned as essential for long-term success. Gladstone emphasizes that maintaining a meaningful stake in the company allows founders to guide its direction, make critical decisions, and remain motivated to achieve ambitious goals. Equity is not just about financial gain, it's about ensuring that your vision remains at the center of the business. To protect your equity, you must first understand how dilution works. Each funding round involves issuing new shares, which reduces the percentage of ownership held by existing shareholders. While this dilution is necessary to secure the capital needed for growth, the terms surrounding it determine the extent of its impact. Anti-dilution provisions, for example, are designed to protect investors from losing value during down rounds, but poorly negotiated provisions can disproportionately dilute founders. Feld and Mendelson emphasize the importance of understanding these clauses and calculating their implications before signing a term sheet. Founder stock vesting is another critical tool for protecting your equity and ensuring alignment with your co-founders and investors. Vesting schedules, which typically span 4 years with a 1-year cliff, incentivize long-term commitment while providing security to the company. Feld and Mendelson advocate for standard vesting terms that are fair to all parties, ensuring that equity is earned over time rather than granted outright. Such agreements protect the company from the departure of key founders while allowing everyone to benefit equitably from shared success. Negotiating the right terms also requires a clear understanding of your priorities. Feld and Mendelson advise founders to balance their desire for high valuations with the need to preserve meaningful equity stakes. A slightly lower valuation with founder-friendly terms, such as capped liquidation preferences or fair anti-dilution clauses, often results in better outcomes than a high valuation paired with aggressive investor protections. Understanding the trade-offs between valuation and equity dilution is critical to making informed decisions that align with your goals. Transparency and trust are essential in these negotiations. Feld and Mendelson stress that founders must communicate openly with investors about their priorities and concerns. Investors who understand the importance of preserving founder equity are more likely to collaborate on terms that balance risk and reward. This alignment not only protects your stake, but also strengthens the partnership between founders and investors. Seeking expert advice is invaluable when navigating the complexities of equity and dilution. Experienced attorneys, accountants, and advisors can help you evaluate the terms of your deal, model different scenarios, and identify potential pitfalls. Feld and Mendelson emphasize that the cost of expert advice is a small price to pay for securing your future. These professionals can also help you craft agreements that protect your equity while meeting the expectations of your investors. Equity protection is not just about percentages, it's about preserving your ability to lead and grow the company. Feld and Mendelson remind founders that dilution is not inherently negative when managed strategically. By raising capital, you gain the resources needed to scale and create value. The key is to ensure that the terms of your deal align with your long-term vision, allowing you to maintain control and reap the rewards of your success. Ultimately, protecting founder equity is about ensuring that your hard work translates into meaningful ownership and influence. Understand how dilution works, negotiate fair terms, and seek expert guidance to navigate the complexities of venture deals. Your equity is not just a number, it's a reflection of your control, your vision, and your upside. Guard it carefully, and it will empower you to build a business that delivers lasting value. Lesson 7. Understand the role of the board. The board of directors is more than a formality. It is a governing body that can shape the trajectory of your startup. Brad Feld and Jason Mendelson emphasize that understanding the role, composition, and dynamics of your board is critical to maintaining control and achieving long-term success. Many founders underestimate the influence of the board, only to find themselves sidelined in decision-making processes when the board's priorities diverge from their vision. Structuring your board thoughtfully and negotiating its composition early are vital steps in safeguarding your authority and ensuring that your company's governance supports its growth. Feld and Mendelson highlight how board control often shifts to investors over time. In one example, a founder agreed to board terms that granted majority control to investors in exchange for funding. As the company faced challenges, these investors made decisions that prioritized short-term returns over the founder's long-term vision. This dynamic strained relationships and ultimately led to the founder's removal from the company they built. Such cases underscore the importance of negotiating board structures that protect your influence while fostering collaboration with investors. This lesson mirrors the governance principles outlined in John Doerr's Measure What Matters, where effective alignment between stakeholders drives success. Doerr emphasizes that clarity of roles, responsibilities, and objectives is essential in building strong governance structures. Similarly, Feld and Mendelson stress that the composition of your board should reflect a balance of perspectives, aligning the interests of founders, investors, and other key stakeholders. A well-structured board is not a hindrance, but a resource that can provide guidance, accountability, and strategic support. To structure your board effectively, start by understanding the stages of board evolution. In the early stages, your board may consist solely of founders or trusted advisors. As you raise funding, investors will typically seek representation to protect their interests. Feld and Mendelson advise founders to negotiate the number of investor seats and ensure that independent directors are included to bring impartiality and expertise. Independent directors can act as mediators and provide valuable insights that balance the perspectives of founders and investors. Clear communication is essential to maintaining a productive board dynamic. Feld and Mendelson encourage founders to proactively set agendas, share updates, and foster open dialogue. Regular and transparent communication ensures that board members are aligned on the company's goals and challenges. By keeping the board informed, you can build trust and minimize misunderstandings, creating an environment where decisions are made collaboratively rather than contentiously. Board governance also requires defining the scope of decision-making authority. While the board is responsible for high-level oversight, operational decisions should remain within the purview of the management team. Feld and Mendelson stress the importance of delineating these boundaries clearly in your bylaws and governance documents. This prevents micromanagement and ensures that the board focuses on strategic issues, such as hiring the CEO, approving budgets, and setting long-term objectives. Building a board that adds value requires selecting members who bring diverse skills and experiences. Feld and Mendelson suggest seeking individuals with expertise in areas such as finance, operations, industry trends, and scaling businesses. A well-rounded board can provide insights that help you navigate challenges and seize opportunities. Additionally, board members with strong networks can open doors to partnerships, talent, and additional funding. Negotiating board terms early is crucial to preserving your influence. Feld and Mendelson advise founders to secure protections such as veto rights on critical decisions, ensuring that you retain control over key aspects of the business. Founders should also consider implementing staggered board terms, which prevent a single group of investors from gaining disproportionate control. These measures protect your authority while allowing for healthy governance. Ethical considerations are central to effective board management. Just as you expect transparency and fairness from your board, you must hold yourself to the same standard. Be prepared to answer tough questions, admit mistakes, and collaborate on solutions. A board that trusts your integrity and competence will be more likely to support your vision during difficult times. Ultimately, understanding the role of the board is about ensuring that its governance enhances rather than undermines your company's success. A well-structured board provides accountability, expertise, and strategic oversight while respecting the boundaries of management. Approach board composition and dynamics with the same diligence and foresight as you would any other critical aspect of your business. Build a board that reflects your values, supports your vision, and adds lasting value to your company's journey. Lesson 8. Plan for future rounds. Venture deals are not isolated events. They are milestones in a larger fundraising journey that defines your company's trajectory. Brad Feld and Jason Mendelson emphasize that each funding round sets the stage for future raises, impacting valuation, investor expectations, and strategic flexibility. Founders who fail to plan for future rounds often find themselves boxed into unfavorable terms or struggling to secure follow-on funding. To build a scalable and sustainable business, you must approach fundraising with foresight and a long-term perspective. Feld and Mendelson highlight how over-optimizing for short-term wins can create challenges down the line. For example, securing a high valuation in an early round may seem like a victory. But if the company fails to meet the expectations tied to that valuation, it can lead to down rounds or strained investor relationships. Down rounds, where subsequent valuations are lower than previous ones, often erode founder equity, damage morale, and undermine market confidence. These pitfalls underscore the importance of structuring each round to support the company's growth rather than inflating metrics for immediate gains. This lesson aligns with the foresight emphasized in Jeffrey Moore's Crossing the Chasm, where strategy must account for long-term growth and scalability. Moore stresses that achieving sustainable success requires careful planning and anticipation of future needs. Similarly, Feld and Mendelson advise founders to think several steps ahead when negotiating terms and setting valuations. Each round should align with your company's broader goals, ensuring that you maintain flexibility and momentum as you scale. To plan for future rounds effectively, start by mapping out your funding needs over the next 3 to 5 years. Understand the milestones you need to achieve, such as product development, market entry, or revenue growth, and estimate the capital required to reach them. Feld and Mendelson recommend aligning your fundraising strategy with these milestones, ensuring that each round provides the resources necessary to hit key targets. This approach not only optimizes the use of capital, but also strengthens your narrative for future investors. Valuation is a critical factor in planning for future rounds. While a high valuation may be tempting, Feld and Mendelson caution against inflating your company's worth prematurely. Overvaluation can create pressure to deliver unrealistic growth metrics, leading to potential challenges in securing subsequent funding. Instead, aim for a valuation that reflects your current stage and leaves room for steady, achievable growth. A balanced approach ensures that you maintain credibility with investors and set the stage for successful future raises. Investor composition is another important consideration. Feld and Mendelson emphasize the value of building a diverse cap table that includes investors with complementary skills, networks, and expertise. Early-stage investors may focus on product development and go-to-market strategies, while later-stage investors bring resources for scaling and preparing for exits. Structuring your cap table with a mix of investors ensures that you have the right support at each stage of growth. Additionally, selecting investors who are aligned with your long-term vision helps to minimize conflicts and maintain strategic coherence. Terms such as liquidation preferences, anti-dilution clauses, and board composition also play a role in planning for future rounds. Feld and Mendelson stress the importance of understanding how these terms impact future fundraising dynamics. For example, aggressive liquidation preferences may deter new investors, while poorly structured anti-dilution provisions can lead to disproportionate equity dilution for founders. Negotiating terms that balance founder and investor interests ensures that your company remains attractive to future backers. Communication and transparency with your current investors are crucial for navigating future rounds successfully. Feld and Mendelson advise founders to keep investors informed about progress, challenges, and upcoming funding needs. Open communication builds trust and fosters collaboration, making it easier to secure follow-on investments from existing backers. It also helps to align expectations, ensuring that investors are prepared to support your company's growth trajectory. Timing is another key element in planning for future rounds. Raising capital too early can lead to premature dilution, while waiting too long may jeopardize your runway and bargaining power. Feld and Mendelson recommend raising funds when you have a clear story to tell, whether it's hitting a major milestone, demonstrating product-market fit, or achieving significant revenue growth. This ensures that you approach investors from a position of strength, maximizing your leverage. Ethical considerations are also part of planning for future rounds. Founders who prioritize integrity and transparency in their fundraising processes build stronger relationships with investors and position themselves for long-term success. Avoid overstating metrics or making promises you cannot keep. A reputation for honesty and reliability will serve you well as you navigate the complexities of scaling your business. Ultimately, planning for future rounds is about creating a sustainable foundation for growth. Approach each funding round with the bigger picture in mind, balancing immediate needs with long-term objectives. Structure deals that leave room to maneuver. Build investor relationships that align with your vision, and maintain flexibility to adapt to changing circumstances. By thinking ahead and acting strategically, you ensure that your fundraising journey supports your company's success at every stage. Lesson 9. Educate yourself constantly. The venture capital landscape is dynamic, with trends, best practices, and market conditions evolving rapidly. Brad Feld and Jason Mendelson underscore that continuous education is not just beneficial, it is essential. Founders who prioritize learning adapt more effectively to challenges, make better decisions, and identify opportunities others overlook. The journey of entrepreneurship is one of perpetual growth, requiring curiosity, humility, and the willingness to embrace new knowledge. Feld and Mendelson share anecdotes of seasoned entrepreneurs who, despite their experience, still learn valuable lessons with every deal. One founder they highlight believed they had mastered the nuances of fundraising, but later discovered a key oversight in negotiating liquidation preferences. Rather than becoming disheartened, they used this experience to refine their understanding, ensuring future deals were structured more effectively. This mindset of learning from both successes and mistakes exemplifies the importance of staying open to growth, no matter how much experience you have. This lesson mirrors the lifelong learning philosophy articulated in Carol Dweck's mindset, where adopting a growth mindset fuels success. Dweck emphasizes that those who embrace challenges as opportunities to learn are better equipped to overcome obstacles and achieve long-term goals. Feld and Mendelson align with this perspective, encouraging founders to view the complexities of venture capital as a landscape to explore and master rather than a series of insurmountable barriers. One way to educate yourself is by immersing yourself in the resources available within the venture ecosystem. Read books, follow industry blogs, and study case studies of successful and failed startups. Feld and Mendelson recommend books like The Lean Startup by Eric Ries for insights into iterative growth and venture deals itself for deep dives into deal structures. These resources provide both foundational knowledge and practical guidance, equipping you to navigate negotiations, build relationships, and scale effectively. Beyond self-study, seek mentors and advisors who can share their expertise. Feld and Mendelson emphasize that learning from others' experiences is invaluable, especially when entering unfamiliar territory. A trusted mentor can provide guidance on structuring deals, managing investor relationships, or anticipating market trends. Surround yourself with individuals who challenge your assumptions, offer diverse perspectives, and encourage your growth. The venture world thrives on networks, and leveraging the knowledge of those around you is a powerful tool. First-hand experience is another critical teacher. Feld and Mendelson stress that nothing compares to learning by doing. Each venture deal, whether successful or not, provides unique insights into the dynamics of fundraising, market behavior, and team management. Reflect on these experiences and analyze what worked, what didn't, and why. Over time, this practice of reflection sharpens your instincts and enhances your ability to make informed decisions. Staying informed also means keeping pace with the latest trends in technology, markets, and consumer behavior. Feld and Mendelson highlight how shifts in venture capital often align with broader changes in the global economy. For example, the rise of software as a service models or the growing focus on environmental, social, and governance factors have reshaped investment priorities. Founders who stay ahead of these trends are better positioned to attract capital and adapt their strategies to meet evolving demands. Adopting a learning mindset requires humility and self-awareness. Feld and Mendelson caution against overconfidence, noting that even the most experienced entrepreneurs can fall victim to complacency. Recognize that the venture ecosystem is vast and constantly changing. No one has all the answers, but those who continuously seek knowledge are better equipped to navigate uncertainty and seize opportunities. Technology also provides valuable tools for continuous education. Online courses, webinars, and podcasts allow you to access expert insights from anywhere. Platforms like Coursera, LinkedIn Learning, and industry-specific content hubs offer targeted learning opportunities that cater to your needs. Use these resources to deepen your understanding of finance, negotiation, product development, or any area critical to your business. Lastly, cultivate a culture of learning within your organization. Feld and Mendelson highlight that successful founders not only educate themselves but also empower their teams to grow. Encourage your team members to seek knowledge, share insights, and challenge assumptions. A culture of learning fosters innovation, resilience, and a shared commitment to excellence. Ultimately, educating yourself constantly is about preparing for the challenges and opportunities ahead. The venture world rewards those who are curious, proactive, and adaptable. By committing to lifelong learning, you equip yourself with the tools to make informed decisions, build meaningful relationships, and lead your company to success. Stay curious, stay informed, and never stop growing. Lesson 10. Align interests. Alignment between founders and investors is not just a desirable outcome, it is a necessity for sustained success. Brad Feld and Jason Mendelson emphasize that misaligned interests often lead to tension, inefficiency, and even the failure of promising startups. When founders and investors are on the same page, they create a collaborative environment where goals are shared, milestones are clear, and decisions are made with mutual understanding. Structuring deals to align incentives builds trust, fosters collaboration, and positions the company for long-term success. Feld and Mendelson recount examples where alignment drove remarkable outcomes. In one case, a founder and their investors agreed on specific milestones to trigger additional funding. This agreement not only ensured transparency but also kept both parties focused on achieving measurable progress. The result was a well-supported growth trajectory that benefited everyone involved. Conversely, they highlight cases where founders and investors failed to agree on strategic priorities, leading to conflict and stagnation. Misalignment can derail even the most promising ventures, emphasizing the critical need to establish shared goals from the outset. This lesson mirrors the philosophy in Ray Dalio's principles, where alignment of goals and expectations is a cornerstone of effective collaboration. Dalio emphasizes that clear communication and mutual understanding create the foundation for productive relationships. Similarly, Feld and Mendelson stress that venture deals should be structured to align the interests of all stakeholders, ensuring that founders and investors work toward the same objectives rather than pulling in different directions. To align interests effectively, start by discussing expectations openly and honestly during negotiations. Feld and Mendelson encourage founders to articulate their long-term vision and desired outcomes clearly. Investors, in turn, should share their priorities, such as desired returns, exit strategies, or timelines. These conversations establish a baseline of mutual understanding and provide a framework for crafting terms that support shared goals. Structuring deals with alignment in mind involves thoughtful consideration of terms such as board composition, liquidation preferences, and vesting schedules. For example, setting fair and transparent milestones for funding rounds ensures that progress is tied to measurable achievements, reducing ambiguity and fostering accountability. Feld and Mendelson also recommend avoiding overly aggressive terms that disproportionately favor one party, as these can create resentment and undermine trust. Exit strategies are another critical aspect of alignment. Feld and Mendelson advise founders and investors to discuss potential exit scenarios early in the relationship. Whether the goal is an acquisition, IPO, or long-term independence, aligning on a shared vision for the company's future reduces the likelihood of conflict when the time comes to make significant decisions. Clear exit planning allows both parties to work toward a common goal, ensuring that their efforts are coordinated and productive. Alignment extends beyond financial incentives to include cultural and strategic compatibility. Feld and Mendelson highlight the importance of selecting investors who share your values and approach to business. Investors who respect your vision and are willing to collaborate as true partners contribute far more than just capital. Look for backers who bring expertise, networks, and a willingness to support your mission, creating a partnership that is both financially and philosophically aligned. Regular communication is essential for maintaining alignment throughout the relationship. Feld and Mendelson encourage founders to engage investors in ongoing dialogue, sharing updates, challenges, and successes. Transparent communication builds trust and ensures that all stakeholders remain informed and aligned as the business evolves. By fostering an open and collaborative environment, you create a foundation for long-term partnership. Ethical considerations are also central to aligning interests. Both founders and investors must approach the relationship with integrity and a commitment to fairness. Feld and Mendelson stress that mutual respect and ethical behavior are the bedrock of successful partnerships. When both parties act in good faith and prioritize the company's success over individual gain, they create an environment where collaboration thrives. Ultimately, aligning interests is about creating a shared vision for success. Structuring deals thoughtfully, communicating openly, and selecting compatible partners ensure that everyone involved is working toward the same objectives. Alignment is not just about minimizing conflict, it's about maximizing potential. When founders and investors are aligned, they unlock the full power of their partnership, driving growth and achieving goals that benefit everyone. Conclusion: venture deals demystifies the complex world of venture capital, equipping you with the tools to navigate term sheets, negotiations, and investor relationships with confidence. Feld and Mendelson's lessons emphasize the importance of understanding the fine print, protecting your equity, and building strong partnerships with investors. This book challenges you to approach fundraising as a strategic process, not just a financial transaction. For further insights, consider The Lean Startup by Eric Ries and The Hard Thing About Hard Things by Ben Horowitz, both of which complement the lessons in this book. Remember, Every deal shapes the future of your company. Negotiate with clarity, plan for growth, and never lose sight of your long-term vision. The end.